Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're going to discuss 5 stocks that are going to perform strongly in 2013. With me is John Abernethy from the Clime Investment Group. John, what are your top 5 stocks for the year ahead?
Well, first BHP. It's probably primed for some sort of recovery. It's in value. I'm predicting a fall in the Aussie dollar, as you know, in the second half of the year, and I'm also predicting an increase in volume of iron ore, and I'm predicting that the energy sector of America will come into play. BHP's there, one of the few Australian companies, so there's a lot going for it in the second half of next year.
So you think the market will be up around 10%? BHP can do better than that?
Probably, yeah.
Okay, second stock?
National Bank. It's a transition year for National Bank. It's the cheapest of the banks, not without good reason, because of the profitability, the poor performance. I think in the next 12 months they'll ring fence UK and they'll put it into runoff, and the market will applaud that, and it'll rally quite strongly, stronger than the rest of the banks.
Okay, number 3.
Certainly the Brickworks Patterson. We've seen the corporate manoeuvrings on the register with Mark Carnegie and friends. I suspect it won't play out next year, but there'll be tension on the share price and tension on the board to start delivering some of that $1 billion of shareholder wealth, which is sitting in no man's land. Okay,
and what kind of capital gain do you see? What do you value at?
10 to 20%.
Okay, let's move on to number 4.
Number 4, I'm packaging up JB Hi-Fi and Harvey Norman because they're sitting in the discretionary end of the retail market. And you'd have to say that if we have lower interest rate in the retail sector, the discretionary part will start rallying, and there'll be some consumer confidence lift. Unfortunately, both of these companies are attacking each other in white goods. So, but you'd have to say that this is the year they have to perform after 3 or 4 years of non-performance.
And you're not overly concerned about the internet and the structural change?
I am, but I think a lot of it's in the share price.
Okay. Final one for the year?
Just a small one, Oroton. It's an interesting year. There's a company which has lost Polo Ralph Lauren licence. They're rolling into Asia, so there's a positive and a negative. Well managed. If they don't replace the licence, a lot of cash comes in, could be a big shareholder capital return in terms of franking. If they buy something, the market might say, thank God for that.
And Oroton's reasonably expensive compared to the market?
No, it's not reasonably expensive at all. It's reasonably expensive going out if they can't replace the Ralph Lauren, but there's possibly a $1 frank dividend there for shareholders.
And what will that deliver in terms of capital gain?
Well, if it carries half that frank dividend and pays its normal dividends, that's about a 10-12% pre-tax return.